Now let's have a chat about the macro. So the macro stuff, the S&P 500 back in a bull market. What? The S&P 500 is in a bull market. Yes, it is true. Now that very specifically means this. The index has risen 20% or more from its recent low. So that is technically what has happened, right? So we've seen that 20% increase, and now we're technically back in a bull market for the S&P 500. Pretty cool. Now it's still obviously a ways away from its previous highs, but it's been performing surprisingly well considering all the crazy that has been going on, right? And we've seen this market rally happen in spite of course, the big interest rate hikes that we've seen going on and all the rest of it. So it'll be very, very interesting to see how this all plays out. Is this the start of a new major bull market, right? Bull markets on average last for 5 years and see a gain of 177%. Is that the kind of situation we're facing up now, or is this just an aberration? Right? This is just a bear market rally, a false signal, if you will, before the Great Depression and the end of all things. The end of all things, guys, not some things, all things. Well, we certainly have a lot of those voices out there screaming that, but it is pretty interesting to see that the S&P 500, the NASDAQ 100, they are at their highest prices that we've seen them in 14 months, right? We've seen them enter back into bull markets. We've seen Apple reach a new all-time high. We've seen NVIDIA reach new all-time highs. Right? And crypto, come on, crypto, man. Eurozone also entering into a recession. So we're seeing a lot of macro stuff that's, some of it's good, some of it's kind of like, what's going on, man? Eurozone sinking into recession as cost of living crisis takes its toll. Now, it's not dramatic. The GDP shrank 0.1% in the first quarter of 2023. So it's not like it's Armageddon in Europe or something like that. But we are seeing some major economies like Germany. Germany sank into a recession, part of the fallout of all the crazy that's been happening in Europe with, certain pipelines mysteriously exploding and all these sort of things. So unsurprising to see these kind of economic numbers coming out of Europe. Although the question then becomes, how bad will this recession be? Is this going to be the recession of recessions, or just a shallow recession that, we slow down for a little bit and then we all kick off later this year? So be curious to see how long that recession actually ends up lasting for. Raoul Pal weighing in on this as well. He says, why do equities continue to scream higher on every negative data point? He said, because the recession we've been calling for was largely priced in back in October. That's a fascinating thought to think about. He said, we're in so many ways, we're climbing the wall of worry right now. Think about that. The worst sentiment in the market, October, November, December, right? It's also when low prices came in. That's when it was the Armageddon is here and, new Great Depression. And there still people are calling for the new Great Depression. Hey, maybe we prove them right one day, but not today, apparently, because we are seeing equities continue to rally higher, which is very, very exciting. So it's very interesting to see how bullish the equity markets have been in spite of the prevailing economic macro fears that we've seen for the markets. Just a quick reminder as well before we break down the T-bill news and the $1 trillion of liquidity coming into the markets, or being sucked out of the markets, we should say. If you're not yet subscribed to the Wealth Master newsletter, guys, check it out. It is the best newsletter in crypto. So do get signed up. Free newsletter goes out to 70,000 readers every single week. Just use that link down below to get all of the latest straight to your inbox. Now let's talk about the Treasury bills. So as we know, the debt ceiling was agreed upon, right? Basically, they written themselves an unlimited check for the next 2 years. So they don't have a ceiling for the debt ceiling right now. The estimate is that they're going to add $4 trillion to the debt by January 2025. I'm sure they'll do their best. They seem to love spending money, don't they? JP Morgan has estimated Washington will need to borrow $1.1 trillion in short-dated Treasury bills by the end of 2023. That's pretty interesting. That's a lot of money that's going to come into the market. So as MarketWatch says here, a deluge of Treasury bill issuance is coming. How could it impact stocks and the broader market? So these are going to be 6-month auctions of T-bills to get that cash pile back up there for the Treasury. So this is a lot of money, right? So as they say, investors are bracing for an estimated $1 trillion deluge of Treasury issuance to start flowing later this week and continue in the coming months as part of the latest debt ceiling resolution. A heavy supply of fresh Treasury debt will refill government coffers, run low by another protracted fight in Washington, but it won't necessarily derail stocks or the broader market, according to strategists. You see, this is the concern right now. We have $1 trillion in T-bills coming in that are probably going to suck up a whole lot of liquidity out of the market because people are just going to ape into them, right? We're going to see money market funds go into them in a big, big way. Now, right now, money market funds only own 15% of the Treasury bill market, but that might change as we see more and more of these come in. Those are, I think they're yielding at 5.5% or something like that right now. So it's definitely a big, big number. We're also going to see the repo markets sucking up quite a bit of that new money, those new T-bills coming into the market. So the question is, can the market absorb this massive influx of Treasury bills and still maintain a bullish, let's say, leaning on the equity markets? Well, the strategists here think yes. And of course, we're talking about very different things here. Treasury bills, the yields are great right now. It's obvious why people are buying them. We've seen a massive increase of money going into these money market funds. We're probably going to see more money going into these money market funds, chasing that attractive yield. That doesn't necessarily mean people are going to sell out of all of their stocks, right? So we can have two things can be true at once, right? We can see these T-bills coming into the market, and we can still see equities continuing to perform. Although it is a real wild card, because you can say, well, it may not have that bad of an effect. It may not derail stocks, the current rally we're seeing, but it might. It might, right? It's a wild card when we see a $1 trillion deluge of T-bills coming into the market. So definitely something to keep an eye on. Ray Dalio coming out as well. The legend, the man, the myth, the legend, coming out and saying the USA is going to issue a large amount of government debt and there is a shortage of buyers. So Ray doesn't think that we're going to find enough buyers for that $1 trillion, as estimates go up to $1.1 trillion of T-bills that are going to be coming into the market. He calls this the beginning of the big cycle debt crisis. Strong words from a very, very knowledgeable investor. And of course, we're seeing more and more gold being bought up by central banks around the world. They see what is happening with the world's reserve currency, the dollar. We're seeing the economic levers being pulled, and everybody faces the effects of that because the dollar is the reserve currency of the world. So everybody has to deal with the impact of what the USA does with the reserve currency of the world. China and many other nations are voting right now with their feet, and they are buying gold. China increased gold reserves for 7th straight month, showing strong demand from the world's central banks. Pretty interesting, right? And they're not alone. We're seeing a lot of other central banks increasing their gold supplies from India to Turkey to Russia and beyond. Wolf of Wall Street said debt ceiling raised, 1 trillion new bonds hit the market, but who is going to buy them? Well, over the past decade, we've seen foreign central banks be the big buyers of U.S. Treasury holdings. But now they are becoming net sellers, reducing their stake by $500 billion since June 2021. So who's going to be buying? The Fed's going to be buying. How's the Fed going to be buying? By printing money. Money, money, money. It's always the same answer. It's always printing more and more money. So we're going to need to absorb all those T-bills, print money. What about the bank funding program? Don't forget the banking collapse stuff, right? There are still a lot of banks out there who are in pretty bad shape, and the Fed is absorbing all of that as we are seeing them use this debt facility, right? Where they can bring in their long-term bonds, where they can bring in their mortgage-backed securities and get dollar value for them. They don't have that money sitting around. Printing it out, baby. They are printing it out. And of course, that was extended internationally. So they're going to have to print even more money. Always the same damn answer, isn't it? Plus, where do you think these trillions of new debt are going to come from? Remember, they're going to spend another $4 trillion that they don't have over the next few years. The money printer will go burr. Liquidity will come back to U.S. markets. Also, like this point here from Stackholder, the Saudis are replacing U.S. treasuries with things that can't be printed. The PGA Tour, Cristiano Ronaldo. But the most important thing here, he said, someone tell them about Bitcoin before we're left with all the scrubs. Now, look, this is a big thing. Again, we're seeing the Saudis. They have been the fortress of dollar reserve status for a very long time. Saudis are done with it. Saudis are starting to look at taking you on. Saudis are getting out of their U.S. Treasury bonds. Saudis are making deals with the BRICS countries. They're applied to join BRICS. I mean, the world order is changing. And slowly but surely, we are seeing money move away from things like U.S. Treasury bonds. Final note here for this broadcast, we have the Federal Reserve meeting coming up next week, June 14th. Now, right now, we have a 72% probability that there will be no interest rate hike at the next meeting. However, we are still looking at a potential for July of a 0.25% increase. Now, if we do pause, if this is it, if we don't see any more interest rate hikes, could be big for the market. That could give us that fuel needed for a rally in the coming months as the market looks and says, it's time, baby. Let's do it. Interesting as well is that the current market, this is the Fed futures market, right? So they're currently pricing in a 41% chance that we see our first cut in November. Determining factor here is that November cut going to happen because the recession's here, everything's really, really bad? Or is that going to cut because, well, you know what? Inflation's been taken care of. We don't need to keep interest rates as high anymore. Markets are still okay. Again, two things can be true at once. The only question is, will those two things be true at once? Okay, that's it. Thank you so much for joining me today, and I will see you next time.